Okay, so now we're going to talk about capital investment decisions. At the end of this textbook, there is an appendix about capital investments. I've included the information from that appendix and some additional information about capital investment decisions. So capital budgeting, as we know, is the process of making long-run planning decisions. Many investment projects take longer than one accounting period. And we usually have more than one project going on at any time. Some of these projects can span over several years. Because of this, capital budgeting takes a little bit more planning than any short-term projects. So there are several stages in capital budgeting. First, we want to identify any projects that we have coming up that we might want to do when we're going to make a list. Usually companies will make kind of a wish list of future projects. Then we gather information about those projects, and all of that information includes future cash flows, future expenses, what the salvage value is on those projects, how long it's going to take to complete those projects, etc. Then we're going to make decisions about which projects actually have a positive value that we're going to reap a benefit from, and we might order which projects we're going to do at what time. When we make the decision to do a project, then we're going to go afterwards and evaluate that project, one, as it's going on. We're going to compare our actual expenses against our estimated expenses. We might revise plans. We might need to go back and make adjustments to our original plans. These things you've done in intermediate accounting when you did completion of project accounting or percentage of completion accounting. This goes along with the capital budgeting. So the capital budgeting part is the planning part, and then the completion of percentage of completion is an evaluation of the project as it's ongoing after you've made the decision to accept it. We use discounted cash flows using the time value of money. So the time value of money tables are included in your textbook. You can also find them online. So we use the required rate of return for the company. This required rate of return is also called the discount rate, hurdle rate, cost of capital, or opportunity cost of capital. You can see any of those terms used. I will probably say hurdle rate or discount rate most often. When you're looking at the net present value method calculations, you want to discount all your expected future cash flows back to the present point in time using our required rate of return or our hurdle rate. Only projects with a 0 or a positive net present value are acceptable. So we're looking at this project here with Yummy Candy Company. They're thinking about buying a piece of equipment that costs $80,000. There's some information here such as their increased annual contribution margin or their projected cash flows for this project are $15,000 for 10 years. Their required rate of return is 6%. Additionally, the other information that they give us is that any salvage value is going to be taken up with their removal value. So they're not even going to consider salvage value or removing the project as part of their calculations. They're also not going to pay any attention to income tax in these calculations. So we have two different ways that we can do net present value. We can do it using our net present value tables or using the formula in Excel. So we're going to use a table first. The nice thing here is that in this example, we have the same exact cash flow rate every single year. If you have different cash flow rates, then you have to discount them back individually when you're doing things like a discounted payback period or other methods that we'll look at in the future. But because we have constant cash flows, we can go to the table we're going to use is the present value of an annuity. So we're going to go to the present value of annuity, and I've just looked up on the internet for time value of money tables. So we want the present value of an annuity. We want 6% for 10 years. So if we look at 6% for 10 years, we see the factor we're going to use 7.36 for this factor. So we take 15,000 times that factor of 7.36. That gives us a value of $110,400. From that value, we subtract the initial cost of the machine. We would also subtract if it told us that at any time that in 5 years there needed to be an upgrade done on it that cost a certain amount of money. We would also want to subtract that. So we would want to subtract any outflows with the project. This gives us a net present value of $30,400. Because it's a positive number, that tells us that this project will more than pay for itself, and it's a good investment. So the next thing that we're going to look at is using the Excel function for net present value. So we would put equals NPV for net present value. We select the rate and then the cash flows. You'll see that that gives us a very similar amount to what we calculated using the factor. From that amount, we would then subtract the initial cash flow amount, and we can add that to the end of our formula. And then we get a net present value of $30,401.31, which is just $1.31 different than the formula that we did when we did the original calculation. We also have an internal rate of return, or IRR, method for evaluating projects. So under the IRR method, that gives us the discount rate at which an investment's present value equals 0. That's when the NPV equals 0. A project then is only accepted if that internal rate of return exceeds the firm's required rate of return for the project. Now, we already know that if we have a positive net present value, that we've exceeded that rate of return. We might want to know, though, what exactly is that internal rate of return. So we have several different ways to do this. One way is a trial and error approach. So we just try to guess what discount rate gives us a number of 0. And we do multiple calculations. The other way to do it is in Excel. So we have this same project and we're in Excel. So the first way to do it is when we look at this 15,000 for 10 years in the table. So what we do is we would take our initial value of $80,000 from the cash outflow divided by our inflows of 15,000. So if we do that, we get 5.33. So in that trial and error period, then we would go to our present value of an annuity table, go across the 10 years, because we're looking at a 10-year period, and find where we get 5.33. On this table, we don't see that, but it's probably somewhere in the 13 to 14% range. The other way that we can look at that is using Excel's internal rate of return feature. So that gives us the internal rate of return for a series of cash flows. So in this example, we just take all of the cash flows. You need to make sure that your initial cash flow is put into Excel as a negative number for this to give you the correct calculation. So that tells us that the internal rate of return is 13%. And we can extend that out to see that it's 13.43%. Net present value is generally used more often than the internal rate of return, but if we're having a difficult time deciding between certain projects, we might want to calculate several different capital budgeting investment calculations in order to see if one of them fares better than others in all categories or just one specific category.